that was made special in some ways by BMW. And those American Express customers got VIP tours of the manufacturing facility in Germany. So really, the smart marketing can be very adaptive to the different needs of the customer and the merchant, but it's a way that Amex gives value directly back to the merchant. So much so that when merchants have left because they periodically get upset that Amex charges more than Visa, MasterCard, over 75% of them come back, which is a pretty interesting statistic. With that, I want to talk about the credit issues. Can we go to slide 44, please? So one of the very interesting questions right now is, okay, we're in a recession. It is likely to get worse based on what everyone is saying. How much pain is American Express going to take? Well, we don't know, and like I said before, it's very hard to predict, but at least we can frame the question a little bit with looking at prior experiences. So in 2001, the after-tax impact to American Express was 97 cents a share in the worst year. In 1991, it was $2.88 per fully diluted share. And that's at a 9.6% total charge-off rate. And what's important to remember here is that is not just the lending business. It's the lending business and the business where the customer pays it off every month, and the small business charge cards, which have a very, very low default rate. So that is applied to the entire portfolio and is really a significant number. If that number gets as bad as a 15% net charge-off, which is so terrible that American Express, when we were on the phone with their finance department, said that if that happened, it would imply over 30% charge-offs for a lot of the rest of the charge card industry and would certainly put out of business a very large number of their competitors. It might happen, but I just wanted to give you a sense of the magnitude of what that number really means to both the country and to the competitive landscape. But if it did happen, it would be a little under $6 per fully diluted share. It would be very painful, but they could afford it, and they would certainly survive and prosper afterwards. Can we go to slide 53, please? Another interesting thing with American Express is to think about over the long term, the market usually gets it about right. You know, we make our living trying to find the inefficiencies in the market, and it's my personal belief that the market has pockets of severe inefficiency, but on average, over time, prices reflect their true economic value. This chart goes back to 1960. American Express actually became a regular way publicly traded corporation in 1965. Buffett bought it a couple of years earlier when it wasn't listed on a regular exchange, but was still a nationally recognized important company. And you can see from the PE chart, we're at about the lowest level that it's been over this entire period, including lower than it was in the 60s, and as low as it got to during the worst in the late 70s, early 80s. It does not mean it can't get worse from here, but it does mean that we're at the bottom of what's historically been true. And the average over this entire time period has been about 21 times earnings. And if you think about it, that's actually rational. For a company with extraordinarily good return on equity and a growing company with a durable competitive advantage and a company that can pass through inflationary costs largely, it's rational that an investor would accept that earnings yield compared to other stocks. The other thing, which we didn't go through the whole presentation, but American Express is a better company now, today, than it was at any time on this chart, because its return on equity is the highest, and it is giving back most of the money it makes to shareholders in the forms of dividends and share buybacks. With that, we'll go to slide 54. There's a lot of ways to value things, and what we try to do is we try to attack things from a bunch of different angles and then apply some common sense to think about where we are in the world and what are the likely outcomes. But we've looked at American Express in many different ways, and the thesis is that it's undervalued anywhere from 2 to 3 times on various metrics over a 5-year time frame. That by no means is implying that it can't get a lot worse from here, but over time, the durable competitive advantage and the shareholder friendliness of the management team should yield a good result, we believe. So in conclusion, we think that they have a strong and growing competitive advantage. It has a historically low valuation. It does have robust long-term growth prospects. And we believe, based on these things, that the intrinsic value is likely a lot higher than at the current share price. So the reason I kept the presentation short is I just wanted to open the floor to Q&A. With that, if anybody has any questions, I'd be happy to answer them. Yes?
What would make you wrong?
Great question, and we have a formal process to vet that exact question. One of the things we do is we write the story. We write the obituary for an idea and think about it. The things that could make us wrong, if the crux of the thesis that there's a durable competitive advantage has to do with the value of their points program and the value of this closed loop that has such good information. So we could be wrong if Visa, MasterCard somehow come up with a way to compete directly with that. We could be wrong if American Express changes its strategy, stops investing in that program, and weakens the competitive advantage. We could also be wrong if we believe American Express has a good balance sheet and ample access to capital. And if we are wrong, and that's something we spend a lot of time focusing on the credit side of American Express, if we are wrong in that regard, then we'll be wrong on the idea.